Hello students, welcome to my class. This is Professor Vincent Usaya and this is the presentation of Chapter 7, Auditing Internal Control over Financial Reporting. In Chapter 2, recall we discussed the 10 generally accepted auditing standards. We indicated that these standards are used as guidelines in auditors performing their work. Number 2, we also said that these standards measure the quality of the auditor's work. In other words, during the course of doing our work, we follow the standards in order for us to do our work effectively. And number 2, as to whether we have done our work well or not, or effectively or not, we use how well we follow the standards to measure our performance. So those are the two primary functions of the 10 generally accepted auditing standards. Number 2, the 10 generally accepted auditing standards as discussed in Chapter 2 are divided into 3 categories. Number 1, we have the general standards. Number 2, we have the standards of field work. And number 3, we have the standards of reporting. Now, we said that the second standard of field work requires auditors to obtain sufficient understanding of internal control in order for the auditor to plan the audit and also to determine the nature, timing, and extent of the test that the auditors desire to perform. Then, in Chapter 6, we zero in on internal control from the standpoint of the second standard of field work. In other words, requiring us to have an understanding in order for us to plan the audit effectively and also to determine the nature, timing, and extent of our test. Now, in Chapter 7, we are zeroing in on internal control again. However, this is from a different perspective altogether. Here we are not only gaining understanding or obtaining understanding of internal control in order to plan the audit and determine the nature, timing, and extent of the test to be performed. Here we are also auditing internal control itself. So Chapter 7 zero in auditing internal control over financial reporting. Now, that is the overview. Let's take a look at the management responsibility under section 404 of the Sarbanes-Oxley Act. We already talked about this act in previous chapter. This is the law that requires management. Again, first of all, I want you to make a note. Here, section 404 deals with management responsibilities in regards to internal control. So the act or the law requires management of publicly traded companies, not every company, to issue a report that accepts responsibility for establishing and maintaining adequate internal control over financial reporting. So they have to issue a report and say, well, we are responsible for not only establishing internal control, but for also maintaining adequate internal control over financial reporting, and also assert that the internal control over financial reporting is effective as of the end of the fiscal year. Moving along, management responsibilities under section 404 continues. We said that in addition to what we just discussed, number 1, management should accept responsibility for the effectiveness of the entity's internal control over financial reporting. Now, listen to this very carefully. We said effectiveness. We are not talking about efficiency. Effectiveness deals with the degree to which something is successfully done, to the degree to which something is accomplished or successfully done. So efficiency, in contrast, deals with doing something with the least expense or doing something with the least effort. But here we are zeroing in on only effectiveness. So management has to accept responsibility for the effectiveness of the entity's internal control over financial reporting. Number two, management is also responsible for evaluating the effectiveness of the entity's internal control over financial reporting using suitable control criteria. What does that mean? For example, if you say to me that you had an extremely good understanding of accounting principles when you had your Principles of Accounting 101, the question is, how do we really know that? A suitable criteria for determining your understanding of the principles and concepts that we discussed in Accounting 101 is to take a look at your grades. If you have an F grade, then it is very likely that you really didn't have a good understanding of the principles and concepts in that class. So here we are talking about management has to evaluate the effectiveness of the internal control of the entity's internal control over financial reporting using a suitable control criteria, which we are going to talk about later. Number three, management also have to support the evaluation with sufficient evidence. In other words, management cannot just say, oh yeah, we have done the evaluation, our internal control over financial reporting is effective. Yeah, you can't just say that, but you have to back it up with sufficient evidence. And number four, you have to present a written assessment regarding the effectiveness of the entity's internal control as of the end of the entity's most recent fiscal year. Now, we are going to shift gear here. Here, we are going to talk about the auditor's responsibility, not management responsibility, but the auditors. So the law or the act, Sarbanes-Oxley Act, also requires the auditors to do certain things. He said that the entity's independent auditor must audit and report on the effectiveness of internal control over financial reporting. What are we talking about here? So here, the law is requiring the CPA firm or the audit firm to audit and report on the effectiveness of internal control over financial reporting, in contrast to Chapter 6, whereby our role as auditors when we are auditing financial statement, not a publicly traded company, was to have a sufficient understanding in order for us to plan and also to determine the nature, timing, and extent of the test to be performed. Here, we are not only doing that, but we are actually auditing and reporting on the effectiveness of internal control over financial reporting. Consequently, the auditor is required to conduct what we call integrated audit. What does that mean? That means we are combining the audit of the financial statement with the audit of internal control over financial reporting. So moving along, let's take a look at the internal control over financial reporting defined. First of all, recall in Chapter 6, we said that internal control is a system that is put in place by the board of directors, management, and other personnel in order to meet three objectives. Number one, reliability of financial reporting. Number two, effectiveness and efficiency of operations. And number three, compliance with laws and regulations. So those were the three objectives of putting internal control in place. Now here we are zeroing in on the first objective of these three objectives, which is reliability of financial reporting. So let's take a look at the definition of internal control over financial reporting. Here we are told that it is a process defined to provide reasonable assurance about the reliability of financial reporting and the preparation of financial statements in accordance with GAAP. Again, like I said, this is the first of the three objectives in terms of internal control system being put in place. So the control should include some of these procedures. Number one, pertain to the maintenance of records that accurately and fairly reflect the transactions and dispositions of the assets of the company. Maintenance of records, accounting records like journal, ledger, so on and so forth. Number two, provide reasonable assurance that transactions are properly authorized and recorded in accordance with GAAP. And number three, provide reasonable assurance regarding prevention or timely detection of unauthorized acquisition, use, or disposition of the company's assets. So we have to put controls in place that include procedures to accomplish these issues. Now, let's take a look at internal control deficiencies defined further. We have what we call a control deficiency. We said that a control deficiency exists when the design or operation of a control does not allow management or employees in the normal course of performing their assigned functions to prevent or deter misstatement on a timely manner. What do we mean by that? See, one of the objectives of putting internal control system in place is to allow the prevention or detection of misstatement in a timely manner during the normal course of employees doing their work. So when the design or the operation of the control does not allow management to make that happen, then we have a control deficiency. In other words, there is a control deficiency in the internal control system. So what do you mean by design? How you put it together, how you structure it. How about operation? You can have a good, solid internal control in place. You can actually design it on paper, everything flows well. But the question is, how do you actually operate it? That is a different ball game. So you can have it properly designed, but it's not operating well, or if you operate it well and it is not properly designed, either way, you have a control deficiency. Now, let's take a look at the extent of the deficiency in the control. We have what we call a significant deficiency. Here we say it's a control deficiency or a combination of control deficiencies in internal control over financial reporting that is less severe than a material weakness. Yes, important enough to merit attention by those responsible for oversight of the company's financial reporting. What does that mean? That means here we are talking about a combination of control deficiencies, either from the design or from the operation or combination thereof, that is severe enough whereby it requires us or it deserves the attention of those individuals or group of individuals that have the oversight responsibility. So from that standpoint, so sorry about that. So that is significant deficiency. Now, let's take a look at another issue relative to control deficiencies, material weakness. Here we said that a control deficiency may be serious enough that it is to be considered not only a significant deficiency but also a material weakness in the system of internal control. What does that mean? That means, let's read further. A material weakness is a deficiency or combination of deficiencies in internal control so that there is a reasonable possibility that the material misstatement of the annual or interim financial statement will not be prevented or detected on a timely manner. So what does that mean? That is simply saying here that the significant deficiency, which we just previously explained, is severe enough or it is bad enough that there is a reasonable possibility that a material misstatement on the financial statement will not be prevented or detected in a timely manner during the course of the employees doing their work. So if it is that bad, we now call it a material weakness. So you need to catch this. So significant deficiency. So we say that every significant deficiency is not a material weakness. However, every material weakness is a significant deficiency. So let me say that again. Every significant deficiency is not a material weakness. In other words, you can have a significant deficiency, but it's not bad enough for us to conclude that there is a material weakness. So therefore, every material weakness is a significant deficiency and not vice versa. So Let's take a look at the last piece. As illustrated on the next slide, the auditor must consider two dimensions of the control deficiency: likelihood and magnitude. So part 2 of this presentation would illustrate how those two issues are used in determining the seriousness of internal control deficiencies.